You've spent years building your business. Your management team has been with you through most of it. They know your customers, they know your culture, and they know how things work. So when it comes time to step away, handing the business to them seems like the obvious move. But most owners don't realize management buyouts often fail. It's not because the people are wrong, but because the structure is. And by the time that becomes obvious to you, a lot of time, money, and trust have already been spent. Welcome back to Legacy, the Business Succession Podcast. As always, I'm your host, Jared Pallon. Today, we're diving into management buyouts. What are they? Why they appeal to so many business owners, and most importantly, the reasons they break down before they ever get across the finish line. So if you have a management team or you've ever thought about keeping the business in the hands of people who helped you build it, this episode is for you. So let's get into it. When most business owners start thinking about succession, they may overlook an option that can provide the best balance between continuity, legacy, and transition flexibility. That being a management buyout. This is when an existing management team purchases the business from the owner. Rather than bringing in an outside purchaser, ownership transitions to people who are already involved in running the company. At first glance, this sounds like an ideal situation. The management team already understands the business. They know your customers, they understand your employees, they know your systems, your processes, and your culture. There is no lengthy learning curve that needs to be implemented upon transition. There's often already a high level of trust between the owner and the buyers. And in many cases, you feel good knowing that the business is staying in the hands of people who helped you build it. For those reasons, management buyouts can be incredibly successful. But they're not always simple. In fact, some of the most challenging succession transitions involve management buyouts. Not because the people are not the right fit, not because the business is weak, but because ownership is fundamentally different from management. Many owners underestimate this distinction when planning for succession. Before we discuss the risks, let's start with why owners are attracted to management buyouts in the first place. For many business owners, maximizing the sale price is not their only objective. Certainly, financial security does matter. But for many owners, they also care deeply about what happens after they leave that business. They care about their employees, they care about the customers, and they care about preserving the culture that they spent years building. A management buyout often addresses those concerns better than a third-party sale can. The management team is already invested in the success of the organization. They typically want continuity rather than disruption upon that owner's transition. They understand the relationships that have been built over time, and because they already know the business, transitions can often occur gradually rather than abruptly. That gradual transition is one of the biggest advantages of an MBO. The owner can reduce involvement over time. The management team can take on increasing responsibility over that course of time. Relationships can be transferred on a gradual basis, and both sides can adjust as that transition unfolds. But there is one major challenge that appears almost immediately: money. Most management teams do not have millions of dollars sitting around in a personal bank account in order to fund the transition. If the business is worth $3 million, $5 million, $10 million, doesn't much matter, the management team usually cannot simply write a check and pay for that transition, which means financing becomes one of the most important aspects of the transition. This is where owners first realize that management buyouts are different from traditional sales. In many cases, the owner effectively becomes part of the financing solution. This is commonly referred to as vendor financing, or a vendor take-back loan. Rather than receiving all the proceeds up front, the owner receives part of the purchase price over time. That arrangement can make the transition possible. But it also means the owner continues to carry some risk. Let me give you an example of how this works. Imagine a manufacturing company worth $5 million. The management team consists of a plant manager, sales manager, and a controller. Together, they have the skills required to run the company, but they do not have $5 million available personally to make the purchase. So a transition plan is developed. The management team will secure some bank financing. Then part of the purchase price is funded through future company cash flows, and part remains payable to the owner over several years. The transaction becomes achievable because it was structured in this fashion, not because the management team suddenly found $5 million lying around under the couch. This is often how successful management buyouts work. The structure creates the opportunity. However, this is also where owners need to think carefully, because receiving payments over time means future business performance is going to matter that much more. If the company performs well, hey, everybody wins. If performance declines, repayment risk to that original owner is very much up for debate. Let me give you another example of why transaction structures matter. Imagine an employee wants to purchase ownership over a number of years. The owner agrees to sell a small percentage of shares annually and finances that purchase through a vendor take-back loan. On the surface, this probably seems like a reasonable arrangement. The employee gains some ownership early on, and the owner receives a stream of payments to pay for that purchase. The transition occurs on a gradual basis, as we've discussed, but a challenge often occurs. Because the employee only receives a relatively small percentage of the company in the early years, they may not receive enough of the economic benefit from the business to comfortably service that debt. The company may be profitable, the business may generate significant cash flows, but that doesn't necessarily mean that that new shareholder has access to enough of that cash to personally make the required loan payments. In other words, a business can be successful while the financial structure to that deal is falling apart. In some situations, the debt obligation grows faster than the buyer's ability to participate in the profits of the business. This result is a transaction that appears workable on paper, but becomes very difficult in practice. That is why management buyouts require careful planning. It's not enough to determine who will own the shares. The ownership percentages, the compensation structure, the financing terms, and the expected cash flow all need to work together if the deal is going to work. Otherwise, the transaction can put pressure on both the buyer and the seller long before ownership transition is completed. A successful management buyout is not simply about transferring ownership. It's about creating a structure that is sustainable for both the seller and the buyer over the long term. So this brings us to one of the most important questions in any buyout. Can the management team actually become successful owners? Notice that I did not ask whether they're good managers. We've already established that. I asked whether can they become successful owners. Those things are not always the same. Some people can be exceptional managers. They execute well, they solve operational problems very well, they're good at supervising staff effectively and efficiently, but ownership requires additional skills that a management role doesn't necessarily have. Owners think differently. You can attest to that. They make long-term capital allocation decisions. They manage risk. They negotiate financing. They evaluate acquisitions. They make strategic decisions that impact the future of the business. Not every manager wants or is capable of taking on that responsibility. Let me give you a third example to illustrate this. Imagine a construction company where the owner has heavily relied on a senior project manager for years. The project manager is a well-respected employee. Customers trust him. Projects are always completed successfully. From the owner's perspective, this individual appears to be the clear successor for the business. So when the owner begins discussing a management buyout, everything looks promising initially. But as they start into this transition process, challenges start to emerge. The project manager is highly capable operationally, but turns out they struggle with budgeting. They have issues with cash flow forecasting. They struggle with financing decisions, and they don't really have a good grasp of long-term strategic planning. The problem isn't their intelligence. The problem is a role transition. The skills that made him an excellent project manager are not always identical to the skills required to own and lead the company. That distinction matters. And it is one of the reasons successful management buyouts often require years of preparation. The strongest MBOs do not begin when the shares are sold. They begin years earlier when leadership development begins. Managers gain exposure to financial information, they participate in strategic decisions, and they learn how ownership decisions are made. By the time ownership changes, they are already thinking like owners. That dramatically increases the likelihood of success. Another factor that deserves attention is lender expectations. Many owners assume that if a management team wants to buy the company, financing will naturally flow. That's not always true. Banks evaluate management buyouts very closely. They want to see strong cash flow from that business. Stable financial performance is very important, and they want to be assured of capable leadership, reasonable debt levels, and have a confidence that the management team can continue operating that business successfully. If the lender lacks any confidence in the leadership capacity, financing becomes much more difficult. This is another reason why preparation is going to matter in your case. The management team is not only being evaluated by the owner, but they are also being evaluated by lenders as well. Let's talk about one of the most common mistakes in management buyouts: the owner who simply cannot let go. This happens more often than people realize. The ownership transaction occurs, the documents are signed, the management team becomes the new owners of that business, but the former owner continues making all of the major decisions. Employees continue to seek direction from him. Managers hesitate to act independently as a result of this, and confusion starts to develop through the organization. On paper, the transition has already occurred. Unfortunately, in this case, it hasn't actually transpired in practice. Let me give you another example to demonstrate. Imagine being in a business where ownership has officially transferred into that management team. The new owners begin implementing operational changes, but every significant decision still gets routed back to that former owner. As a result, employees are unsure who has the authority, and the management team then becomes frustrated with the process. As a result, decision-making processes slow down, and the confidence within the business begins to erode rapidly. Again, the issue is not the documentation. We signed the papers already. The issue is the leadership transition. Authority must move alongside ownership. Otherwise, the transition remains incomplete. It's for paper purposes only. This is why the governance aspect is so important. It's important to set up clear shareholder agreements, define the responsibilities, set up decision-making frameworks, put in some sort of transition timeline, set up communication plans. These are all elements that help clarity for the owner, the management team, and the employees. This clarity reduces conflict. The strongest management buyouts combine several characteristics. The management team is capable, the financing structure is realistic, and the owner is committed to transitioning their authority. The process, like we've mentioned, is gradual. The expectations are clearly documented, and when those elements come together, management buyouts can be incredibly effective. I've seen it myself. Employees retain continuity, customers experience stability, the owner achieves succession objectives. And the management team has the opportunity to build on an already successful foundation. Like most aspects of success planning, however, success rarely happens by accident. It is usually the result of preparation. Communication is important. The structure in that organization is important. Most importantly, time is important. Let me leave you with 3 takeaways from today. Number 1, management buyouts can create exceptional continuity. Ownership transition to people who already understand the business, the culture, the customers. That is genuinely valuable. That's what we did here at the firm. Number 2, the biggest challenges are almost never about people. They're about the financing structure and the leadership readiness. Both require preparation that starts well before any deal is ever discussed. Number 3, the strongest management buyouts don't begin when the shares are sold. They begin years earlier. By the time ownership changes, that transition has already happened. If today's episode made you realize that there are gaps in your succession planning thinking, whether it's around financing, governance, leadership, readiness, or something else entirely, our business succession ebook is a practical place to start. It's free, and it's designed specifically for you, the business owner, who is navigating these decisions. It's available right now at legacyllp.ca. If this episode was useful, please subscribe so you don't miss what's coming up next. And if you know a business owner who has been thinking about transitioning their business, please share this episode with them. In the next episode, we're tackling one of the most emotionally loaded questions in family business succession planning. How do you balance fairness and control when family members are involved? It's a conversation that can break relationships when it goes wrong and strengthen them when it goes right. We'll talk about how to get it right on that episode. Thanks again for listening to Legacy, the Business Succession podcast. If you're building something meaningful, it deserves a thoughtful transition. Thanks, and we'll talk again soon.